Good day, fellow investors. Each year we once discuss Bill Ackman, the investing superstar. This is his annual presentation, strategic updates, always there with Bill Ackman. We'll discuss that, the strategy, and most importantly, the positions. For those who don't know me, my name is Sven. I run a value investment-oriented research platform. I share my portfolios. I have free buys. If you want to check that, feel free to improve the context of what we are doing here. But we're looking for margin of safety, owner's earnings, and driving returns from owning businesses. A little bit different than what Bill Ackman is doing. But okay, if we look at the portfolio, top position Brookfield, Uber, Amazon, and that's almost half of his portfolio. At Google, you are at 60% in 4 stocks. Very concentrated. Nevertheless, that concentration, he is after your money, our money again, wanting to set up a structure that can last forever, but years are going by, Bill. That's something, I hope it works for him now to launch this new fund or go public in the States and get his 20 billion. Nevertheless, board meeting, perhaps a dividend policy, share buybacks, fee amendment, debt strategies, Howard Hughes strategic transactions, discount to NAVs, all those kind of things that Warren Buffett hadn't had to worry much about. If we go to performance, again, performance, 1 year performance is irrelevant, but what I'm looking at is, okay, Warren Buffett did what he did, but Bill Ackman is trying to beat the market at the market's game. And it's not working. For the past 5 years, he has not beaten the S&P 500, but he's using leverage, which should have helped him. However, if you're smart, you don't need leverage. If you're not smart, you shouldn't use it. I think Bill Ackman is very smart, so he doesn't need leverage, for example. But okay, you say 20% of the portfolio, not that much. Buffett has his float, but float is free money, not 3.5% leverage. That's also something very important. Then he has strategies to address the discount. I once calculated the discount, and if you calculate the taxes you should pay as an investor at liquidation, that justifies the discount. Nevertheless, new IPO, going for that, reducing fees a little bit, we'll discuss that too. Howard Hughes, strategic opportunities, but it has been a bad story there over time. Now he's going into insurance, and 2025 was the best year for insurance in the last 15, and now you're making an acquisition there. Okay, but great business, growing, everything good, great. And then nobody can argue with Bill because his performance has been stellar. But his performance, you look at this and you think, look how he destroyed the S&P 500. Look at this, look at this. Now, if I would put a chart like this, there would be immediately comments, Sven, this should be a log scale, this should be that, this should be left, this should be right, and that is totally right. No beating the market in the last 5 years. There was one discrepancy here where he did greatly. When the market went down, his portfolio went up because he made a deal with Goldman just before the pandemic craziness started that he will pay money constantly. He closed that deal, made 2 billion and something in less than a month. That was the great trade for him and the differentiation. But we'll discuss that more a little bit later. If we look at the target, it looks like Warren Buffett, predictable cash flows, barriers to entry, moat, no exposure to extrinsic values, strong balance sheets, attractive valuations, minimal capital dependency, so they are not needing new capital, large market capitalization, great management. So it looks like Warren Buffett wrote this himself. But let's go to the stocks. Portfolio developments, Hertz, Amazon, Meta, Chipotle, Canadian Pacific, Hilton, Nike. And the plan there is to buy Amazon, AWS, growth, Meta, AI growth, Hertz, turnaround. But his take on the market is that everything will keep on growing fast, therefore the market deserves higher multiples. So he's trying to do everything like Buffett we have seen in the targets. Bill Ackman is fully invested, aggressively investing. Warren Buffett has left Berkshire to Greg with $370 billion in cash. We'll discuss also another reason why that is so very soon. But still, if we look at his strategy, he thinks that his positions are undervalued and that the earnings growth are faster than the market, and that's how he will beat the market. The thing is that he needs to beat the market because of this. So performance fee 16%, management fee 1.5%. So even if he just does as the market 10%, when you calculate these fees, that's 300 basis points lower. So equal at the market, he's down 40% of your wealth. He needs to beat the market by those 300 points and then more just to justify the situation. And if we look, since he changed his structure, since the IPO of the Pershing Square, because I always look at his numbers, but this is the IPO. So we have to look from the IPO date, the performance. So from here to here, from here to here. I asked my assistant to calculate that. Here we go. S&P 500, 0.04 percentage fee. Bill Ackman, 3% fee or more. This is the total shareholder return. But let's go to America and get another 25 billion from people that simply likely didn't make this calculation. Nevertheless, opportunities, his narrative, Google, he did great with Google, great buy at the right time, hats off there. Nothing wrong to say there. Then we have Uber, huge growth at low valuations, should dominate. Amazon also. He could be right. Facebook, AI not priced in. He could be right there. Brookfield, the largest position, great asset management fees, structural positions, solutions, things like that. Managing, targeting 7 earnings per share in 2030, 25% compounded growth. And Bill Ackman is chasing that. Did a few videos on that. If you want to learn something and have a laugh, look at this video. Put the link in the description below. He bought at a good price. We are now at 38 or something, so still positive. We'll discuss that when I give you my opinion. This is just discussing Bill Ackman's now. Uber, growing, expanding, exponential growth, nothing wrong there, but you can still buy it at the price almost as good as Bill Ackman's. Freddie, this is something I have no comments on, no understanding there. Amazon, big investors buying hyperscalers, AWS, nothing wrong with it, I think. It's good for a good position in Bill Ackman's fund. Then we have something that has been struggling for a while, especially since Bill Ackman has touched it. We'll discuss that a little bit more, but he's looking at growth, and then perhaps his biggest mistake. Trades at 18 times earnings, 17 times earnings. That's not cheap. 7 times earnings is my portfolio position. That's cheap. And that's the result. You can trade here at 25, you can even grow earnings, but if you trade now at 17, nothing happens. Google, is it time to sell? You made your money, Bill. Okay, Meta, beating the market, trying to beat the market, all things like that. Hertz, turnaround, not going to bother too much there, because if Uber works, Hertz is gone. If autonomous vehicles work, this is gone. Chipotle, he sold a little bit too late, he bought great, but okay, still made some money there. Nike, he's out, okay. Let's learn more about a few businesses there. We discussed Amazon video just a while ago, everyone is buying. Logically, nothing wrong with Amazon, great business. Everything is growing, huge demand for AWS, and the market isn't really reacting to that. It's afraid of the CapEx expansion, which in Amazon's case could still be good because of the great margins there. So you can check my Amazon video for more. But the bet Bill is doing here is that Amazon will beat the market. He needs to grow faster than the market. He needs to improve the multiple to the markets. And is that investing or gambling? And when I look at this portfolio, Brookfield, private equity. Why did he buy Brookfield? Because it was going up, private equity was the hot story, and now that story has started to revert. We'll discuss that. Brookfield, all great, all growth, but when I look at Brookfield, as I did in these videos, when I look at what they are buying, you can check also my private equity bubble video, where just recently people said, I nailed that one. And then if I look at Brookfield, and you will say, Sven, you're not digging deep enough. Okay, everything great. This is how they value their businesses. So the market says 38, but they say 68. And that's how they value all their businesses, because then they put this number, these are the distributable earnings. What's realized is just this, what they can sell. Then I look at what they are doing, 20 billion AI, everyone is investing in AI, 100 billion AI infrastructure. What's the advantage there? I look at acquiring Fosber, things like that. I look a little bit at the EBITDA or the valuation. They're buying at 20 times earnings or even more, 15 times EBITDA. And when they bought this Neoen Renewables in France, I said, okay, this is crazy. The value is 2 billion. They pay 6 billion because they can borrow, they can find equity. But if you pay 6 billion for something where the true value, the book value, the creation, the yield there is 2 billion, long term, you can make money only on promises and financial engineering. And they just keep on doing that, borrowing to do more. And I don't need to look deeper. This is the video for answering all of those. Sven, you're not digging deep enough. Yes, I am. I know enough. I have seen enough. And to quote Charlie Munger, be careful of the 3 M's. Mark to market, mark to model. What private credit in private equity is doing is the mark to MIT situation. The danger of marking to model where private equity or illiquid funds report smooth, high returns that are disconnected from the value, volatile market reality. Good luck. Bill 16% of your portfolio on a bet. Why? Because you need to beat the market and you just wanted to ride this. You felt an idiot for not riding this here. Anthony Robbins opened a business here. Now that looks ugly. Bet on Uber. Why? Because you say it's trading at 21 times earnings, but the market doesn't agree. Okay, everything great, autonomous vehicles, coverage of the whole United States, the world, corporations still growing, everything great, but then everything is based on non-generally accepted operating income, not real cash flows, a lot of stock-based compensation, looked a little bit at the numbers, and net income is not 10 billion. When you deduct the provision, the benefit from income taxes, true net income is 5 billion. 5 billion, 150, the P ratio is not 21, is 30. From one side, if you deduct the stock-based, it's 50 and things like that. So it's a bet. If it works, Billy's ego will go to the moon. If not, I don't know. Nobody cares about the chart we started at the beginning. This is the last IPO promise he made. Now he's looking for new money because that's the nature where you invest on gambling. If we look at Facebook, I made a video, too cheap, 266 billion market cap, 99.20 stock price. Why didn't Bill Ackman buy it there? That's what I don't understand. He has a team, he has the knowledge, he has everything. If he wanted to own Facebook, that was the time to buy it. He's buying it now based on AI. This has to be adjusted. Okay, it's still cheap. When we adjust for this beautiful bill provision, 30 earnings per share, okay, but this is now the elephant in the room. The capex will it lead to returns? We will see, and that's a problem now. So he's buying it into a problem, making it another bet. And they are pushing it to 120 billion cash flow capex, which is insane. Same story with Universal Music Group, promising growth. Then I look, okay, there is some growth. Taylor Swift is still singing. Net profits, EPS, no real great growth. And then this is, again, all adjusted. When I look at the free cash flow, This is the free cash flow, 700 million euros. The market cap is here. The PE ratio, the price to creation, is 15, not 17, not cheap. Bill Ackman is gambling. He's not investing on real value creation. He's investing, gambling in a way, because he needs that market. He needs to beat it. He needs to justify his fees. If not, his empire crumbles. And I don't think that Bill Ackman is in a good place now. No performance, he's gambling, and this great deal that saved him over the last decade, just that one bet. And people think he invested 27 million and gained 2 billion. No, he made a deal with Goldman that he will be paying 260 million negative carry per month, 2-point-something billion over 2 years to get that protection. If the pandemic didn't happen in that way, and if he didn't monetize it at the right day, luck, then it would be a destruction of his returns. Not this one gamble benefit that saved him. That's also something people forget. This is investing. And with Bill's ego, this is all ego, performance, pressure, because you might not hear it, but he's getting calls every day. If I'm paying 1.5% plus 60% on performance, and I'm not beating the market for a decade, for 5 years, that's not something that makes investors happy. And actually, if we look, this is Bill Ackman's superstar performance, and he hasn't beaten the market since. So 12 years of minus 3%, and that is a big deal. So I'm worried about Bill's sleep quality, especially if there is a recession. These are all gambles. If AI creates a boom and leads into competition, autonomous vehicle competition, it's risky. And furthermore, it's risky because it's not simple. It's not predictable cash flows. Perhaps, yes, good businesses, Amazon, but there are barriers to entry with Uber. Limited, perhaps not. Brookfield has no competitive advantage. Everybody's chasing those deals. Limited exposure to intrinsic factors, recession, very big exposure. Strong financial profile, your biggest position is private equity. Very levered. Attractive valuations are P ratios of 7 to 12, as Berkshire is waiting. Not P ratios of 17 to 25 and then let's hope. Minimal capital market dependency, okay, the businesses there are okay. Large market capitalization, why am I paying such fees for things that I can do it myself? Exceptional management and governments, I don't know. Always something to learn from Bill. I'm very negative because it's just not my style. So I know the comments will be disastrous because I discuss all these companies, but in this market, Bill Ackman is chasing performance, is chasing the billions from the new IPO. He needs that performance. He needs to do good to get a better situation there on the IPO. That's what he's focused on. Constantly strategic updates, this and that, left and right, instead of just investing his 2 billion, not always chasing this greatness. And I think that all what he's going on, not performing as hoped, is all that he put on himself. If he just stick to himself, manage his own 2 billion, he would probably have more money than he has now. But you have employees, Warren Buffett had very few, teams, things like that, structures, New York, Goldman Sachs, friends, this and that. And that's the story, unfortunately, of Bill. I felt this over the last few years. Now this is just being confirmed. We have seen the performance. Okay, we all did somewhere like that, 15% over the last 8 years. I did. The market did that. Bill likely did that. But the difference is I'm not promising that I will outperform the market. I'm trying to find businesses where I do my 10 to 12% per year from an earnings perspective growth. And that's it. What the market does is irrelevant. So it's just a little bit different. I think my life is much more enjoyable than Bill's. Again, all personal preferences. I wish him luck. I wish that his bet works. And that's it. unlikely that we'll cover if there are no sensational news or changes there. So I hope you enjoyed this. See how his investing fits you. I'll see you in the next video.